Let's talk about the costs to speculate in the two markets. What are the capital requirements and costs to speculate with futures versus stock options? The initial capital requirement and cost structures vary significantly. Futures trading generally requires a higher initial margin and comes with daily settlement risks, as well as maintenance margin requirements. Whereas stock options trading can be initiated with a lower capital outlay premium paid, offering a higher risk-reward ratio for the capital invested. Let's start by discussing the capital requirements and costs to invest using futures trading. Futures trading often has higher margin requirements because it typically involves higher initial capital due to margin needs. Traders are required to deposit a margin, which is typically a fraction of the total contract value, to hold a position in futures. This margin serves as a form of security against potential losses. The need for a margin deposit, which can be a significant portion of the contract's value, can make futures trading less accessible for traders with limited capital. Futures contracts are subject to daily settlement, meaning the profit or loss on the contract is adjusted at the end of each trading day. This process, known as mark-to-market, can lead to daily margin calls if the market moves against the trader's position. Traders must be prepared to meet these margin calls, which can require additional capital and add to the overall cost of trading futures. While leverage in futures trading allows traders to control large contract values with a relatively small amount of capital, it also amplifies both gains and losses. This can lead to significant financial risks and additional costs if market movements necessitate frequent margin adjustments. In contrast to futures, stock options trading can be initiated with a lower capital outlay. When buying options, traders pay a premium, which is the cost of the option. This premium is typically much less than the cost of purchasing the underlying stock outright, making options trading more accessible for smaller investors or those looking to reduce upfront investment. The premium paid for buying an option represents the maximum risk for the buyer. This means that the potential loss is limited and known upfront, offering a more favorable risk-reward ratio, especially for conservative investors or those new to trading. The ability to define risk clearly is a significant advantage for options traders. While the initial capital requirement may be lower in options trading, implementing more complex strategies can involve additional costs. These include brokerage fees, especially if the strategy involves multiple transactions, and potential costs associated with time decay, otherwise known as theta, particularly for options writers or those holding long-term option positions. The choice between futures and stock options trading should consider both the initial capital requirement and the ongoing costs associated with each type of trading. Futures trading, while offering the potential for substantial gains, requires higher capital investment and comes with the risk of significant additional costs due to daily settlements and margin requirements. In contrast, stock options trading generally allows market participation with a lower upfront investment and a more controlled risk profile, albeit sometimes at the cost of additional complexity and potential time decay. Investors and traders need to weigh these factors against their investment goals, capital availability, and risk tolerance to choose the most suitable trading approach. The intricate tapestry of futures and stock options trading, each with its unique strategies and market approaches, offers a vast landscape for investors to navigate. These two distinct realms cater to diverse trader profiles. Futures trading resonates with those seeking a direct, high-leverage approach to market direction, while stock options appeal to investors desiring strategic diversity and alignment with various market perspectives and risk profiles. The decision to venture into either of these realms hinges not only on an investor's financial aspirations and market acumen, but also on their appetite for risk and strategic preference. As we transition from these concluding thoughts, it's clear that understanding the nuances of both futures and stock options trading is not just about choosing one over the other. Instead, it's about recognizing the unique opportunities each presents and how they can be used in tandem or independently to achieve a well-balanced, robust investment portfolio. In the next section, we delve deeper into these markets. We'll unpack the intricacies of each, exploring how they can be harnessed effectively to meet a range of investment goals and styles. From the adrenaline-fueled world of futures trading to the strategic depths of stock options, we invite you to join us on this journey of discovery. Whether you're a seasoned trader or just starting, this exploration aims to enrich your understanding and guide your decisions in these dynamic segments of the financial markets. The financial landscape offers distinct opportunities through the realms of futures and stock options trading, each with its own set of strategies and approaches. These two trading forms are critical for investors to understand, as they can significantly shape a well-rounded investment portfolio that resonates with personal trading styles and objectives. Futures trading embraces high leverage and direct market engagement. Futures trading emerges as a top choice for those seeking a direct approach with potential for significant market impact. This trading method is defined by several characteristics. Let's discuss some of the most important characteristics. In futures trading, leverage plays a central and crucial role. The utilization of leverage allows traders to exert significant control over a large underlying asset with a comparatively modest capital investment. This aspect of leverage can lead to substantial gains, but it also escalates the potential for significant losses. It highlights the crucial importance of adept risk management in futures trading. Understanding and effectively managing leverage is key to success in this trading domain. Futures traders often engage in what is known as directional trading. This type of trading typically involves taking positions based on anticipated movements in specific market directions. Success in directional trading hinges on an in-depth understanding of market trends and the ability to swiftly adapt to changes in the market. Traders must stay informed and responsive to market dynamics to capitalize on these anticipated movements. Additionally, futures trading usually attracts individuals with a short-term investment focus. The specific nature of futures contracts, combined with the notable impact of leverage, makes it particularly appealing to traders who aim to capitalize on quick market movements. These traders are often looking to profit from short-term fluctuations in the market, aligning their trading strategies to benefit from these rapid changes. Beyond the realm of speculation, futures also serve an important role in hedging against price movements in various assets. This function of futures contracts is particularly beneficial for businesses or investors who have exposure to commodities or currency risks. By using futures for hedging, they can effectively manage and mitigate the risks associated with price fluctuations in these markets. This hedging aspect of futures trading provides a critical tool for those looking to protect themselves against adverse market movements, making futures a versatile instrument not just for speculation, but also for comprehensive risk management. Stock options trading offers diverse strategies and flexible market approaches. In contrast, stock options trading presents a more varied landscape of strategies, appealing to a broad range of market views and risk appetites. Options trading includes a wide variety of strategies tailored for different market conditions. This richness in strategies allows traders to utilize methods like covered calls for generating income, protective puts for hedging purposes, and various spread strategies to take advantage of different market sentiments, whether bullish, bearish, or neutral. These diverse strategies enable traders to adapt and profit under various market scenarios. A key feature of stock options trading is the defined risk profiles it offers, especially for buyers. In stock options trading, the level of risk involved is typically lower. The maximum risk for option buyers is usually limited to the premium paid for the option. This limitation provides a more controlled way for traders to engage in speculation or to hedge their other investments. Moreover, stock options trading offers significant flexibility in responding to market views. Traders in the options market can profit not just from direct market movements, but also from situations where the market is stable or even from different levels of market volatility. This flexibility allows traders to tailor their strategies to align with a wide range of market predictions and volatility scenarios. Additionally, unlike futures trading, stock options trading can be used for longer-term market plays. This is possible because options strategies can be based on broader market forecasts or the performance of individual stocks over a longer period. This aspect of stock options trading provides a different type of investment opportunity compared to the typically shorter-term nature of futures trading. Traders can thus leverage stock options for more extended market strategies, broadening their investment scope beyond the immediate and often more volatile futures market. Making the informed choice aligns with individual investment goals and capabilities. The decision to engage in futures or stock options trading depends on the investor's personal financial goals, depth of market knowledge, risk tolerance, and investment timeframe. Futures trading, with its straightforward approach and significant leverage, may suit those comfortable with taking substantial market directional risks. In contrast, stock options offer strategic diversity and defined risk, appealing to those seeking versatile strategies and controlled risk exposure. Education and diligence are key to success in both futures and stock options trading. Therefore, success in both futures and stock options trading is grounded in thorough market research, ongoing education, and diligent risk management. Navigating these markets requires not only a grasp of their respective mechanics, but also a commitment to staying updated on market conditions and regulatory developments. Whether opting for futures for their leverage and directness or options for their strategic depth and risk control, informed decision-making is the cornerstone of thriving in these dynamic financial arenas. In the complex and multifaceted world of financial markets, futures and stock options trading stand out as distinct entities, each offering its own unique array of strategies, challenges, and opportunities. Having established a solid understanding of their fundamental differences and primary characteristics, we now transition into a critical exploration of the specific trading techniques and strategies that drive success in these two diverse realms. Futures and stock options trading are not just about selecting the right instruments. They are about mastering the art of strategically wielding these tools to align with individual trading goals and styles. In this comprehensive segment, we will delve into a variety of techniques and strategies uniquely suited to each trading form, enriched with real-world examples, case studies, and expert insights. Our goal is to provide a nuanced understanding of how these instruments can be effectively utilized across different market scenarios. Futures trading emphasis on leveraging market movements and managing risks. In futures trading, the strategies often revolve around leveraging market movements, hedging against potential risks, and seizing short-term opportunities. We will explore how futures traders employ methods like day trading, swing trading, and position trading to navigate market volatility and trends. These strategies will be brought to life with practical examples, showcasing how they play out in real market scenarios and are influenced by individual traders' risk tolerance and investment goals. Stock options trading might be more geared towards generating income and speculating with flexibility. Turning to the world of stock options, the strategies take on a distinct focus. Here, traders engage in income generation, market speculation, and meticulous risk management. We will examine how options traders use strategies like buying calls and puts, writing covered calls, and crafting various spread strategies to maneuver through diverse market conditions.